I believe this will be helpful to any new traders who want to trade futures products, understand the landscape of each futures product, how each futures product behaves differently, and so then they have some more context when they go and place trades, whether it's putting their stop losses in, take profits, or putting a wing in or something like that. So studying daily ranges will give you context, and so that's the goal for this market metric today.
We like it.
Alrighty, so
let's do it. Intraday scalping zones, and by the way, we'll be your harshest critic on this one, just so you know, because when it comes to intraday scalping zones, that's kind of like this is kind of like something that we've been talking about for literally for years. So, hang on one second. Let me just get there. You go. All right. So we used to do it as a measure of kind of whatever the expected move was for the day. So like, let's just say 1/2 a standard deviation to 1.5 standard deviations, think about that way. But we haven't really done a lot of work on intraday scalping zones for quite some time now. So I think this is going to be really cool.
And it's also interesting, Thomas, that you're doing this now when we're seeing a lot of two-sided markets. It had a massive rally for the past 6 months. Now it's getting choppy, and there's a lot of whatever your take is on the market or whatever, there's some opportunities right now that I think we haven't seen in a while.
And you're talking to somebody that, I don't know if you know this, but I grew up in this business as a scalper. First 20 years of my career, I just stood in the pit and scalped, and like everybody else did. So this is kind of this whole scalping thing. I want to cover it more, but we haven't on the network. Tony was a scalper too. So let's do this. Intraday traders rely on speed, intuition, and often guesswork. But how far do prices really move on these days? We analyzed intraday ranges to define realistic scalping zones. All right, let's go next slide, John. So scalping zones are based on intraday price ranges from 8:30 to 3 p.m. at Central Time. For each symbol, we measure the 50th percentile, the 75th percentile, the 95th percentile, and the daily range. Okay?
Yeah, these were the three things I decided to use. The 50th percentile being like a base case, the 75th percentile being some sort of stretch, then 95th percentile being some sort of outlier or extreme move in the market. I also made sure to add a formula at the end that kind of shows how I calculated the daily range as a percentage of the open price.
So today, we'd be way outside of this.
That is correct.
Okay, let's go next slide. So we pulled 1 minute. OHLC is open, high, low, close data. We analyzed the ES, the NASDAQ, and the Russell. Use the futures, but it doesn't make a difference. Crude oil, gold, silver, Bitcoin, and ETH, and the last 12 months.
That's correct. Yeah, and I used our Jupyter notebooks that we use internally for our research, for all the research projects. So I wanted to include a snippet just to kind of show the viewers kind of what we do in the background and kind of how we pull data.
Good.
Yeah.
Little glimpse into the
little glimpse.
Yeah.
Of course. Yeah.
I like it. All right. Let's go next slide.
All right.
All right. Go ahead. I'll let you take it.
Sure. Yeah. This first plot, I made it a little bit more complicated than it probably should have been, but let's talk about box plots. So what we're looking at here, that colored in zone is an interquartile range. So it's between the 75th percentile and the 25th percentile range. So right now, as you can see, that red line, that is the 95th percentile range. That is the outlier moves. The orange being the 75th percentile and the 50th being the median. And so as you can see, when we look at the first three box plots, those are the indices. They trade at a very small, the IQR, the interquartile range is sharp, it's lower, it's not as wide. So those are good futures products I would recommend for small and consistent scalps. And then when we look at commodities, you kind of get also that small range, but not exactly with the CL, but they offer some more movement with still a good amount of liquidity and volume in those products. And then we're looking at Bitcoin and Ethereum at the end, the last two, where they see massive moves. Even their 50%, their 50th percentile moves, the base case, is much higher than ES's or the S&P 500 futures 95th percentile move. And so those would be products I would definitely want to position smaller in, and definitely don't have as much volume as the indices.
Yeah, and the markets aren't nearly as tight.
Yeah,
they're not as good.
What I want to add here is box plots have been around for a while, But what you see here is a good intuitive explanation of what they represent. So if you've been trading for a while, of course, ES and NASDAQ equity indices a little less volatile than something like Bitcoin or Ethereum. Okay. And what Thomas has done is shown much wider ranges, wider boxes for the more volatile things. That's what a box plot shows you, well, literally visually. Okay. So you can see here, obviously, crude oil is more volatile than gold. Bitcoin is more volatile than crude oil, et cetera, et cetera.
Let's take a look at the next slide.
Sure.
So crypto has the widest intraday swings. I don't think that would surprise us. Commodities offer solid movement, and the equity indexes are more stable, which favors scaling in and out with precision.
I think an easier way to describe that would be I would increase the size of my positions if I'm scalping in equity indexes compared to cryptocurrency.
Okay, that's an absolute no-brainer. I think that when it comes to scalping, you got to realize that 98% of all scalping is done in the ES. I mean, some people will scalp NASDAQ, and there are a few firms that will, they'll make markets in crypto, so they'll scalp it. There's also some market makers that will scalp, like, bonds and some customers scalp bonds and crude oil. But for the most part, the equity indices, specifically the ES, sometimes the NASDAQ, but specifically the ES, are the primary vehicle. Let's go to the next slide. So the NQ offers the richest daily range, which I don't think that would surprise anybody. The ES is usually, the ratio of ES to NASDAQ is usually, depending on where we are, you can do it 3-2 or 2-1. The Russell is more like 5-2. So if you're just thinking of what the ratios are, the Russell ranges are modest but consistent. I think that's fair. The ES remains steady near $70 per day. It's 70 handles per day, and yeah, I think that's an average.
That's correct.
But you went back to the beginning of the year for that average, right?
That is correct. Yeah, the last 12 months.
Right, last 12 months. Because right now it's a little less than that. Right now we've been in the 60 range. Let's go to the next slide. So volatility peaks in April, likely due to earnings or macro catalysts. I mean, this year it was all the tariff stuff.
That's
but
right.
after spikes, movements tend to compress, yes, and can use this to adjust trade size and expectations month to month. Yeah, I mean, sometimes April's a nothing month. This year it happened to be crazy, but I think that's all pretty fair. I mean, that's exactly how we trade.
Just to confirm some of the data here, what you also saw was a spike in the VIX, right, in April, because like you said, with the tariffs and all that jazz. And the point is, market movements and volatility, implied volatilities, are very closely related. They're not 100% correlated, but yeah, you saw, just like we saw a spike in the VIX in April, we also saw a spike in the scalping ranges.
And that mean reversion also is shown here as well, with that compression after that big spike in April. Yep.
Let's go to the next slide. So using scalping zones to structure trades. So this I'm curious about. So take us through this.
Sure. So let's talk about when the markets are in a base case. I mean, that particular day of trading is a normal choppy day. It's a base case. What I recommend, or a use case for this days, would be to fade extreme movements, scalp the reversals, and make your targets tighter. Anything you want to add to that for that first case?
So the 50th percentile just means if the expected move is, let's say, $60, your base case is a $30 handle move.
It'd be 50% of the average. Yeah.
50%. So fade extremes, well, that's what we are. We're contrarians. Scalp reversals, I mean, that's the same thing. It's the contrarian play. And the tighter targets, I would totally agree with that.
Great. All right. Then the next case would be the 75th percentile. So let's just say we're in a trending market, stretching. The use case in that situation would be to lean into a trend, use wider targets, and trail your stops.
When you say lean into a trend, you mean what?
What I mean by leaning into a trend is to...
Are you fading that trend or are you buying that trend?
I'm buying the trend.
Okay, because we would be we would still be fading the trend.
So
Okay.
you'd be leaning into a trend. In other words, at a down day today, you'd be shorting this down move.
You would be, because this is outside the range today. Because today we're in the extreme case. But
Right.
if we're inside of kind of a normal move for the day, we're usually on the contrarian side.
Okay.
That's what I think of when I say lean into a trend. I agree with the wider targets, because if you're moving more, you want to widen the targets a little bit. The trailing stops for us are mental. They're not hard stops. They're not orders that are resting. They're just mental stops.
Sure.
Okay.
And then, yeah, for the 95th percentile or the extreme market condition or outlier breakouts, the use case would be to widen your stops and avoid early exits.
Yeah, and that's where we stop fading. So the difference for me is when you get an extreme move like today, I'm less likely to fade it intraday. So for a scalp today, normally if we were down, let's say 30 handles, I would get long. If we're down 50 handles, I'd still get long.
Okay.
But if we're down 100 handles, I'd get short. So that seems kind of weird, but big moves outside of the normal range I feel like they have a smaller chance of intraday reversal. So I feel like it's a better play to be on the same side of the market than to a reversal.
Yeah, like another way to put it is anything within the IQR, the interquartile range,
Yes.
fade the scalp or fade the reversal.
That's what I would do.
Yeah.
I don't know about you, TP, but that's my 2 cents. Let's go next slide. All right, what do you got here?
All right. So I have some implications. I added like a bonus graphic, a volatility radar. If you look at the first three on the like top from the beginning to the right, or the first subset of a graph, you have the indices, and you can see that their range is very short or small, 1.4, 1.8, and 2.2 respectively. Then you go to the commodities, you have some inconsistencies, but much greater range. And then when you go to the cryptocurrency, the ETH and the BTC, you can see that that 68, the standard deviation of the daily range, is much greater. So what are some implications from this? You can avoid overtrading by anchoring trades to an expected range. You can adjust sizing by symbols, so do not treat the ES and the BTC the same. And don't chase. Know when you're in a typical day versus an outlier day like today.
Well, I think one of the really good takeaways of this is the don't chase rule. Because what I've learned over the years is if you miss it, you miss it. Don't chase.
Yeah.
And it's easier said than done to know when you're in a typical day versus an outlier day, because you really don't know. I mean, today they were kind enough early on to give you an outlier day, so you didn't have to guess. But normally it's much harder than that. But the don't chase rule is really important.
So the two things I'd say about this, the nice thing about when you're talking about adjusting size, what you can do when you're doing this at home is the size of the contract and the buying power requirements sort of even them out. So you can see, okay, how much does it cost? What's the capital requirement to buy an ES versus buying BTC, for example? You factor in the capital requirements and you factor in the volatility, and that starts to give you a solid number of, okay, I'll buy, 5 worth of ES and only 1 worth of Bitcoin, for example, whatever the capital is. So that's the sort of thing that the way I would do this is look at the capital requirements and try to have them balanced. As far as don't chase, one of the things that I like to tell people is money doesn't care. Your Netlink, your bank account doesn't really care what symbol it came from. If it's not working out in ES or Bitcoin or whatever, don't hesitate to look to another product. We are product indifferent. Thomas looked at 7 symbols, awesome symbols, very highly traded. But if they're not working for you on a particular day, either don't worry about taking a day off, or go look at some other products.
Let's go to the last slide. So, key takeaways. Each future symbol has its own personality. I completely agree with that. ES, tight and tame. BTC, wild and tame. Now, just to be fair, nobody really trades BTC futures. I just want to be really clear about this. They're a massive contract. So, BTC futures are, let's see, right now they're they're 500 and there's $600,000 a contract. Right?
It's a lot.
Right. There's $600,000 a contract in notional, but you have to put up like over 40% of that. So you're talking about like $250,000 just to trade a Bitcoin future.
It's $232,000 to buy one of those futures versus ES.
And just so you know, only 7,000 have traded today. So we don't really, nobody scalps Bitcoin futures. You wanted scalping products, you'd scalp ES, you'd scalp ZN, you'd scalp NQ, you could scalp CL. But those are the, if you're trading futures, MES, MNQ, that kind of stuff.
So
Percentiles.
ES 23,000. Bitcoin futures are 10 times the requirement of ES.
Yeah, that's the other problem. Yep. Percentiles help define risk-adjusted trade expectations. Mm-hmm. So you can't know if a 95th percentile day is coming. That's accurate. But when price is already there, you know the odds of further extensions are low. I agree. We're there today. We've already seen that happen. Understanding the intraday range, understanding the range of intraday moves can benefit traders who are looking to scalp or fade large moves. Like I said earlier, we will fade half a standard deviation, 3/4 of a standard deviation, but once you get outside of a standard deviation and you're up to your 95, 100%, we're done. We're not fading anymore. We can still trade it, but we're not fading.
Yeah, and I just think that adding more context for traders, especially new traders, and adding more filtering when you want to execute a trade, I think it results in better trading and better results. So more filtering.
I think this is a great presentation, and what I would suggest is go back to tastylive website, go to this market measure, load up the slides, and have those box plots and that bar graph that Thomas created, just have that up and running. If you're going to try and, if you don't have the trading experience to kind of intuitively understand NASDAQ versus ES versus Russell versus Bitcoin, have that data in front of you. It is very informative.